Hey guys, welcome back. So Josh Lewis and I are back with our bi-weekly update on, the mortgage market, the real estate market, and things that are trending between the two. This last week, some information came out that I wanted to discuss with regards to self-employment and how self-employed borrowers can now, how they're going to qualify for refinancing and purchasing, with all the changes in COVID and how it's affected income, et cetera. So they've done guidelines, which I did a video on yesterday, which I'll link to here below, which is essentially me reading the guidelines. But Josh is going to give us an interpretation of those guidelines, help us understand them a little bit more. And then we're also going to go back and touch on interest rates, right? We did a video last week where the audio was absolutely awful, and for those of you who stuck through that video, we appreciate it. But I want to touch on what we discussed in that video in a little bit more detail with some clarity, because I'm still getting people emailing me, commenting on the videos constantly. I mean, a couple of times a day, where I discussed UWM, United Wholesale Mortgage, and the Conquest program that they're offering, where they're offering 2.5% interest rates on 30-year fixed. And a lot of you guys have reached out and said, hey, can you put me in touch with one of these brokers? And a lot of you guys, I referred to two different people, and then the last few have hesitated on sending you anyone just because of the video that we did last week. And so I'd like to get Josh to clarify, kind of not the quasi marketing they're doing to get you to click on it, the clickbait advertising to get you to look at the 2.5%. But anyway, he's going to touch on that, and hopefully the audio is better through this case. But before we get into it, I'm Jeb Smith. I'm a real estate broker here in Southern California. Josh Lewis is a mortgage broker here in Southern California, and we're here to guide you through the mortgage real estate process, help you understand it. If you're new to us, do me a favor, hit that subscribe button to keep updated on everything real estate and mortgage related, including trending topics like forbearance and all that good stuff. And I'll link to Josh's contact information below if you want to speak to him directly like we've done in the past. But let's get into it. So sorry for the long intro there, guys. But so this week, Josh, we heard from Fannie Mae, and they've come out and said that, okay, these are the guidelines that we want servicers, lenders to use in qualifying self-employed borrowers going forward. So let's touch on that for the moment and get into it. So if you're like me, you're self-employed, right? And I'm in a position where I want to refinance, right? And my current interest rate's in the around 4%. And so I'd love to take advantage of the market right now, but because I'm self-employed as a real estate agent, my income was affected with deals falling out of escrow and just, all of that good stuff through February, March, and April. Now we're back on track and what have you. But if you looked at my financials from those 3 months, I'm not in a position to qualify, right? Based on what we're talking about here. So let's get into it and kind of explain it in a little bit more detail.
Absolutely. The guidance from Fannie was overdue. And for the most part, we haven't seen Freddie with their follow-up announcement, but everything so far COVID related, those two have mirrored each other identically. So Fannie Mae, Freddie Mac, the conventional loan underwriting guidelines, they came out and actually gave us written guidance as to how we should be underwriting self-employed borrowers, which is super helpful because for the last couple months, every lender has made up their own guidelines. And some of them are far more restrictive than what Fannie has come out with, a few of them a little bit less. But in super simple terms, what they're saying is we have to have a year-to-date profit and loss that confirms income, and it needs to be consistent with where you were the previous year. Because the reason why that's important is we can't go with a profit and loss. A lot of times people will come to me and say, hey, I'm self-employed. Last year, the business made $200,000, but this year we're on track to make $2 million. Say, well, that's wonderful, but we can't go off of year-to-date figures. We have to go off what was actually presented to the IRS. The lenders look at it and say, hey, if you gave it to the IRS and you signed under penalty of the law with the government, then we can rely on those numbers. With a P&L that you're just signing saying, yes, this is real, you can create that in QuickBooks, you can do it in Excel, anyone can do it. But what Fannie is saying is we need year-to-date profit and loss, and we need 2 months of bank statements supporting that level of income, and it needs to match the previous income. So we can probably go more in depth on this later when we actually have a few files where we've gone through and seen how it works in the real world. But the biggest takeaway from that, what most lenders were reacting to before this guidance came out, their guidance or overlays were that we need bank statements for the last month showing income consistent with the previous income. So if we said, hey, based off of 2019, you made $12,000 a month, I need deposits to your bank account equivalent to $12,000 a month. Then we need something written from you stating why your business wasn't shut down or negatively impacted by the coronavirus, and then a P&L showing year to date where you're at. So really, we see it, to me, it breaks down, it's about 50-50 in terms of clients that are self-employed borrowers that either were or were not impacted by this. I have a client that he runs a janitorial service, and a lot of their customers are medical facilities. They actually have made 125% this year relative to what they had made the previous year. So obviously with that, we document everything, and then everyone goes, hey, this is wonderful. I also have a buyer who wanted to buy here. She owns a hair salon. The hair salon was completely shut down. We've had no deposits for the last 2 months. So it's been a big question for us in the interim and going forward of what that's going to look like. The one that's going to be crazy is what happens next year for people that want to buy whose businesses were shut down for 2 months. So their income dropped 15-20% for 2020. But it wasn't their fault. It wasn't anything negative about the business. It was simply the fact that their business got shut down for 2 months, which should not recur. So I think this is not the last of the guidance we're going to see from the agencies. We'll need FHA and VA to chime in as well. But it's a pretty good first start in that it's a reasonable way for lenders to ensure that borrowers actually have the income that they're being qualified off of. Because as we all know, lots of businesses have been negatively impacted and don't have the income that they showed on their most recent tax return.
Okay, so let's use your example for just a second. So you're saying $12,000 a month in income. So let's take the hairdresser, right?
Yep.
And just play this out, right? So she didn't have deposits for 2 months. And let's say let's starting in May, she has that $12,000 deposit, hypothetically.
Yep.
Hairstylist or whoever. And then in June, she has another $12,000 deposits. So in July, she's now got that 60 days of $12,000 deposits, right? So that is in line with her income, although she missed, February, March, April, hypothetically, in this example, didn't make any deposits. But in theory, she could say, hey, this is my profit and loss. I've made $12,000 a month every month, and I've shown you the last 2 months. Does that meet qualification guidelines, or do you think they're going to go back and say, okay, well, let me see the bank statements from those previous months as well?
The guidance says they don't need any additional bank statements, just the most recent 2 months, commensurate with what you've had on the P&L and in previous years. It's just we're going to have to put some files through and see how underwriters come back of what they're asking for. Because again, on some businesses, I mean, there's so many different types of businesses. I have people that, their gross receipts are $2 million a year, but by the time all the expenses go through, it's an $80,000 income. And that looks very different when you're analyzing bank statements and is that income coming in, and 2 months off for that business, it could be a much larger negative than it would be for the hairstylist that brings in $125,000 a year and writes half of that off. So it's going to be interesting, and it's largely going to be, as much as we would love for the agencies and underwriting guidelines to tell us exactly specifically what happens. We've never been here before. We've never seen this stuff. So largely, to me, it always comes down to how do we package the loan, and remembering an underwriter wants to stay within the guidelines so that they can have a saleable loan in the secondary market, whether it's FHA, Fannie, Freddie, VA. That's number one. But also, even if they're within the guidelines, they want to make sure that this borrower has the ability to repay. They don't want to put people into bad situations and put them at risk of losing their home, having a negative credit event. So a lot of this comes down to common sense and packaging it right and saying, why is this person a good credit risk? And, we've talked about this before. Unfortunately, in the mortgage business, it's an 80-20 business, just like real estate. 20% of the people are really good, really proficient, really experts, and 80% fall below that standard. If you're self-employed, it's more critical for you than almost any other type of borrower to get with someone that really knows what they're doing. There's so many potential ways for a file to go wrong when someone doesn't understand tax returns, tax analysis, and these guidelines that we're talking about. So that would be my number one takeaway, is just get with an expert that deals a lot with self-employed borrowers, that's really comfortable with tax returns, and doesn't just tell you they're comfortable with tax returns, but can demonstrate it in their discussion of your situation, that they can walk through your tax return with you and show you what an underwriter is going to look at, what can be added back in, additional deductions that we have to take away from income. And if they can't answer that, it's really critical for self-employed borrowers to get with someone that can.
No, and again, I mean, I'm thinking out loud here too. And like for me, for example, as much as I would love to say my business is consistent every single month, I make, X amount of money every single, that's not realistic, right? There's some months where I don't make any money. And then some months where I make 4 or 5 times what I did in 1 month. So, it's going to be interesting to see how they do interpret bank statements, because, the majority of my income can come in 4 or 5 months.
And you guys aren't the only business. Realtors are super seasonal. People love to move during the summer months. A lot of homes change hands, but there's lots of seasonal businesses. What if you run a bait shop and people don't fish unless you're in Minnesota on the ice in the middle of the winter? They're fishing when the weather's good. There's any number of businesses that are super seasonal, and trying to look and see 12 consistent bank statements is pretty tough.
No, I agreed. So I think we've touched as much as we can on that subject at the moment with what we know. But let's talk about UWM and rates, right? I mean, I'm not singling out UWM, but I am, because they're the ones that came out with the initial, and I'm going to call it clickbait, right? Because it's easy to look at it. That's what got me saying, hey, they're offering interest rates between 2.5% and 2.99%. I go out on a video that I'm doing and say, hey, look, this is what I read. And now I'm getting a lot of people reach out to me saying, hey, look, where can I get that rate? And then we had the conversation. And so let's talk about them as well as the other people out there. And then also on the same line, every Thursday we get an update that says that interest rates are at a new low, right? And we talked about this in the last video as well a little bit, but because of the audio, I thought we'd touch on it again.
Absolutely. So again, this is not to pick on United Wholesale. They actually have 1/3 of the wholesale business. So 1/3 of all loans that are done through brokers go through United Wholesale. Very well-run company. A lot to like about them. This specific situation, I will call it clickbait, because there's nothing unique about it. They branded low note rate loans and branded it and calling it their Conquest program. If you haven't done a loan with UWM in the last 18 months to get you over to their team, they'll offer you these extraordinarily low rates. Yet when you run it through Loan Sifter, which is the program that we run our loans through, they never come up as the best price lender on the low note rates, despite the fact that no other lender has branded their low note rate loans, called it a name, and said you have to qualify for it above and beyond qualifying for the mortgage. And again, for me, if they pop up and they're 1, 2, or 3 in the pricing for one of my borrowers, I know they have great service. I know we can close loans quickly, efficiently, easily. Their technology is good for borrowers. So by all means, we might put a loan with them there. But every person that's contacted me through your videos, the videos that we've done here asking about UWM pricing, never once have they popped up as the best priced lender at the low note rates. And the most important thing is, I shouldn't say the most important, there's 2 really important things here. If you want to get a 2.99% interest rate, a 2.875 interest rate, and you're really well qualified, meaning 740 or above credit score, 70% or lower loan to value, and with that, we can generally get you under 3% with 1 point, a little less than 1 point, and that can make sense for some borrowers. But when you run around on Good Morning America saying, hey, we're offering rates as low as 2.5%, anyone that hasn't refinanced in the last 3 to 6 months should be talking to a loan officer to get this rate. You got to look at, why would a lender want to put a 2.5% rate on the books? They don't make any more. So they're charging you 2.5 or 3 points to get a 2.5% rate. It doesn't mean they're making more. It's not a profit incentive. But if you look back as late 2018, we had interest rates that were approaching 5%. Well-qualified borrowers were in the high 4s. Less well-qualified borrowers were in the low 5s. Well, all throughout 2019, when rates are dropping, those people are refinancing their loans. So the loans that were put on the books were paying off really quickly. Lenders can look at this and say, hey, there's a chance rates could go even lower here. How could we prevent that? Let's get people to pay for a rate so low that even if rates went lower, they wouldn't want to refinance that off the books.
Interesting.
What we're telling most of our clients right now is if you have a 3.5, a 3.375, that's a very good interest rate. We're doing low and no cost loans in that 3.25 range, but if you're already at 3 3/8, 3.5, I would hang out and see what happens. I can give you a million actually factually backed reasons why I think rates are going to go lower. And I can tell you several reasons why I won't guarantee it. Can't guarantee it. If I'm a betting man, I'm going to say 2-to-1 odds that rates go even lower from here. So for clients, the first lady that had contacted us about the UWM, when we show her the numbers at 2.875, paying a point, I don't like that. Okay, well, we can do 3.25 at 0 points with $1,500 of total cost, and you can go from 3.875 to 3.25. That makes all the sense in the world. So we have a lot of people saying, hey, we may need to do this again in 12 to 24 months if rates slide lower, but it's truly the bird in the hand. We know what's here right now. There are really smart people. A guy I love to follow, John Malden, every year he does the Strategic Investment Conference. They had to do it online this year, but it's 5 days of videos of really smart people. And there's ones that are telling you that rates are going to zero, and there's ones that are telling you this is leading to hyperinflation. I think the majority consensus is that rates are going to at least remain low, if not slide even lower. But long way of saying, there's good reasons why different things could happen. So if you have the ability to lock in savings going forward, absolutely do that. And sort of the last thing that you hinted at that I love to tell people is every Thursday and Friday, when we're in an environment like we are right now, I get emails, phone calls. Hey, I saw rates are an all-time low. Can we rerun my numbers? Well, we just ran the numbers a week ago when they had hit an all-time low. And this is not to disparage consumers, but it's the way the media presents it. Every week they want a headline that says mortgage rates hit all-time low. Right. Well, if we pulled up the chart and showed it to you here, they're literally talking about 0.02% better than the week before, 0.05% better than the week before.
So when you say that, like, I know what it means, but what does that what does that mean to the consumer? So to them, 0.02% means 0.02%. Does that mean that my 2.5% interest rate that is being offered is now 2.3%? Or
no. So think of what they're
8%, or what is it? What does that mean?
Let's look at what the media reports. Every week on Thursday, Freddie Mac releases their primary mortgage market survey. So a couple things. It's already a week out of date. It's saying the loans they purchased in the prior week, what was the average rate and the average amount of points paid. So couple things. We do very few loans with people paying points prior to the current market where people are wanting to buy rates down into the twos. But it'll say 3.27 with 0.34 points. And then the following week, it'll be 3.24 with 0.4 points. For all intents and purposes, that's noise. It's the same rate week after week after week. If we wanted to go super inside baseball and pull up bond charts, the thing that you'll see is the prices being paid for mortgage bonds in the secondary market have been incredibly consistent for the last 70 days. And if anything, they've been getting slightly lower, meaning rates are slightly worse. But through that time, lenders have been getting more capacity, getting more competitive, and getting more comfortable with the forbearance risk. So rates have continued to slide better, even though the prices paid for bonds in the secondary market are off a little bit. So by all means, most people right now can benefit from a refinance. I would say 3 out of 4 people that I talk to can benefit. And if you're the super conservative type and you want to lock in the 2.875 and pay a point, I'm not going to argue with that. But I'd love to show you the numbers of saying, hey, 3.25 at a $1,500 total cost versus, a point plus $2,500 of costs at 2.875 is probably better for most people. And at the end of the day, none of these are wrong answers. These are all great options, and we're fortunate to have them. What probably the biggest thing that I'll leave you with is what I really, really get disappointed with is seeing borrowers talking to the major big box call center lenders. The person that you're talking to has probably been in the business for less than 2 years. When you call one of those call centers, they are not built off of getting you lower interest rates. TV commercials cost a lot. Radio ads cost a lot. So if you hear a company's name 5 times a day, every day, all over TV and the radio, and in any magazine you pick up, they're not going to give you the lowest rates, and you're absolutely not getting expertise. Because if you want to be the biggest lender in the United States of America, you can't have the best loan officers. You have to fill a call center with as many young kids as you want. And to their credit, they do have pretty good training systems to turn a Domino's pizza delivery man into an acceptable loan officer in a pretty short period of time. And I mean that honestly, they do that. They take people with no experience in the mortgage business and make them a reasonable loan officer in a fairly short period of time. But nothing about that call center environment is about expertise, about advising you, about helping you manage your home equity and build your net worth over time. So it's not self-serving, because I can tell you, I'm more than happy to compare loan estimate to loan estimate against them, because we're cheaper. We're cheaper, and you get to talk to an expert. And I'm not the only one. I'm one little guy here in California, but I know 500 of me around the country that all of you would be better talking to.
No, understood. So, I mean, with that said, Josh, I don't know if you can throw your information up on the screen. I can always link to it below. I know you have the ability here to do that. So if you can, throw it up there. If you want to contact Josh, the information is there at the bottom. And if you're in another state outside of California, do me a favor, either contact Josh or myself. Again, I network with not only top real estate agents, but a lot of mortgage professionals as well in other states that can guide you through that process and have the same conversation that Josh is. But either way, whatever you feel comfortable with, do that and link below. Last thing I'm going to touch on, Josh, is just one thing that I hear often. And that is, people are in a 30-year fixed. They're at, say, 3.875, maybe 4% or whatever. I don't know what rate they're at, but they're at a rate that's higher than where their market rates are at the moment. And I hear them say, I'm thinking about a 15-year fixed, because a 15-year fixed is the rate's even lower than that of a 30-year fixed. So are you seeing at the moment, because when you go up, right, and when you go down in rate and you go less in terms, right, so you're going from 360 months to 180 months, your rate is going, your payment is going to go up, right? People don't understand the jump there, that even though the rate goes down, that jump from a 30-year to a 15-year is substantial, especially here in California with our loan amounts. But are you seeing that make sense for a lot of people at the moment, or is it still?
The longer they've been in their loan, the more it makes sense. If someone has that 3.875 they took out in 2012 and they're 8 years into it, we're only going from a 22-year amortization to a 15, so it's not going to be that bad. But a lot of the people that are 2 years in, they look at the numbers and they just about faint. And the funny thing is, although I may not look as old as I am, when I was doing loans in the 90s, and rates were at 8.5%, 9%, and you could get 1% lower for going with a 15-year, because there was so much interest in that loan. When you looked at the amortization schedule, just cutting, it was 50% interest and 50% principal. Right. Well, now with rates so low, the interest portion is really low, and you're already paying a lot of principal in the early going. That principal just now has to be paid back over such a shorter period of time, and then you're seeing 0.5% or less payment savings. Doesn't make it a bad deal. It just means it's a bigger jump in payment for most people. We do a handful of them every month, and what I would like to say for most people, you're better off sticking with the 30 and either putting more into your 401k, making the additional principal payment. And the reason being, the next time we hit something like the coronavirus crisis, you have a smaller payment, you have more in savings to rely on. We have a lot of people that had to go to forbearance options because they didn't have any savings and they weren't able to make their payment. The lower we have that payment, the more you have in savings, the less susceptible you are to a future shock. Now, if you're just the people that I say that I love to put you into 15-year, and we've done this, I'm doing one for a client right now. This guy cannot save money. However much money he has, he spends. Always makes his mortgage payment, and it does qualify and can handle that 15-year. So when we look at the numbers, absolutely, we are putting you into a 15-year, and 10, 12 years from now, you're going to thank us for doing it, even though he won't have as much money to spend right now.
No, understood. Yeah, it doesn't matter if you save money if you're just spending it. So there's got to be a plan there. So I think we're at 24-ish minutes now. Any last parting words? Anything that's happened this week that you feel like you want to touch on?
No, like I would say, we're only here in California. I know YouTube is nationwide. People are watching this and wanting to get information. Talk to a mortgage expert. Even if you want to call one of the big call centers, make sure you call a local broker as well and just compare numbers and compare the experience. For the most part, I think you're going to notice a pretty big difference between dealing with someone that's done this for 20 plus years and someone that's done this for 20 plus months. And if not, and you have great numbers from someone in a call center, then you at least know you did your due diligence and you can go that route.
No, yeah, absolutely. And I would say the same thing with interviewing agents, right? If you're going to list your house, don't just go with the one guy, right? Interview multiple people to see what other people are offering, even if you've already made up your mind. Just that way you can confirm that you made the right decision, right? So that's
Yep. Yep.
all right, awesome. So those of you who are still watching, a lot of you have done this. If there's topics you want me to touch on, Josh to touch on, do us a favor. Link below. Josh has videos that he does on Facebook live and some of these other social platforms where he does live videos. So if there's a topic that you want him or I to touch on, in one of those videos, whether it's live or something like this, leave it in the comments below or reach out to us directly. You have the information there. As always, we appreciate you watching, appreciate the support, and we'll see you again soon.
Thanks.
See ya.